Fantastic. How is everybody doing today? Happy, I hope. All right, let's see what's going on. We have a little bit of a dip going on, but nothing serious. Oil now. Oh, here's a good one. Look, if you're looking to trade something in the futures, you look for things that have hit a certain resistance point, like gasoline and oil right here. Now, oil below 40 should have a bounce of some sort. This would have been great to catch it right on the nose, but just for an exercise, let's take a look and see if we can trade that. So we want to catch it before it goes over the $40 line, just for a quick, a single, let's see what price we're going to get. Well, it would be, oh, there we go. All right. So we got it at $39.94. So basically, once it goes over 40, we're going to be up a few bucks, and we can set a stop at 40, and that's the end of it. And we'll just see how high it goes. Very simple. So you just want to catch it on the way up. We know it's going to hit some resistance at 40, so it may not work out. But if it does work out, if it does come back over 40, then we expect a bounce. And how much would the bounce be? Well, it consolidated a bit at the 41 line, fell to 40, so that's $1. Had a little bit of an overshoot. In fact, exactly a 20-cent overshoot, which is 20% of the move. So then we assume that 420 is going to be the weak bounce line. 440 will be the strong bounce line. So I would think we'd get at least a weak bounce back to 440, back to 420 before it gives up. So we'll see what happens. There's bound to be some buyers that has some interest down here at 40. The inventory wasn't that bad. We already looked at that earlier, but let's take another look just to be safe and make sure we're not misreading it. Where was that? EIA, there you go. So we're going to refresh this and see what the date says. October 16th. Now, this is nothing more than a high probability play. And, we're not going to lose more than a couple $100 on it, but if we're wrong, we're going to stop out. But if we're right, it could easily make us 200. It should make us easily $200 on a nice move. And we've only got the one contract, so we're just going to see how it goes. And once you're doing that, we should look at the dollar. Oh, DXY. Not looks very helpful when it looks like this. It's like a broken indicator. It's not very useful. But we get to watch the dollar and get an idea of what it's doing. But we have another way to watch the dollar, and that's this one, the futures chart. A little delayed, though, unfortunately. I imagine I could pay for it, not be delayed. But, the dollar kind of is holding a base down here at this 92.50 line, so that's good. And but we don't want the dollar to go up. This is a 5-minute chart, don't forget, so it's not the hourly chart. Okay, on the whole, we're down here. But we don't want the dollar to come back too much, because that's going to put pressure down on oil. And we'll see how that works out for the next small while. Oh, see, it went down further. Oh, no, I'm sorry. Well, it came back a little bit, but we're still around 40, so we'll be okay for a while. See how it hangs out. What were we going to look at, though, that was important? Oh, yeah, the EIA report. So the EIA report, you always make sure you're looking at the right date, which we are. October 16th was a few days ago. Imports 5 million barrels a day. Pretty low, actually, for the net import. See, we're netting out 3.2 million. So we're sending out 3.2 million. What happens is we're taking in, I don't know why that's a discrepancy. Crude imports average 5.1 million barrels a day. But then it says here 2.5 million, very different number. Petroleum products out 3.2 million per day. So we're sending out 21 million barrels a day of refined products. That means a lot of what we're using in oil is being sent out to other countries. Almost 15% of our total consumption is just stuff we're making for other places. So that's real terrible demand numbers. So even given that, you still have a rise in oil inventory. So even though we're using 21 million barrels a week for other countries, we still have $1 million rise in our net inventory. Crude oil inventories are about 10% above the 5-year average for this time of year. 10% above the 5-year average. That's a lot. Gasoline inventories are 1.9 million barrels. Those also increase. So oil and gasoline increase. Very bad consumption numbers. They're about 2% above the 5-year average. Distillate inventories decreased by 3.8. So again, this is another week where we're getting distillates out, but it was probably because we're exporting them. You know, that's mostly why we're getting rid of these distillates, because we're exporting those. And all other oils actually went down a bit from last week, so that's good. So the net's not terrible. In fact, the net stocks overall are better than they look. It's 2043, 2035. There's a net draw in the overall inventories. So it's nothing to really panic about, and I think that's an overreaction in the oil market. Although now we're, not getting better, so we'll see what happens. But I think it's worth a play north, and we'll see what happens. Somebody hopefully will say something and knock it up a little bit. Let's go back to an index. So we got the Dow, the NASDAQ, and the S&P. And remember, the 3420 line is our critical support. So we haven't tested that yet, but we're down around that zone, so we'll see what happens. And what else is exciting? Oh yeah, I was gonna look at the news. I remember there's a couple of news items that were interesting. Nope. Is this the news? Oh, okay, that's because Seeking Alpha is confusing them. They put these great big graphics in the middle of the news. So the saga of AMC continues. They are trying to get money in, so on and so forth, and diluting. It's really nasty. More junk bond debts are being issued. Everybody's running on borrowed money, cheap rates, blah, blah, blah. At some point, this is going to end. So now, this is very bad. Think about how bad this is for auto retail, for automobile dealers. Now Fiat is doing more online with the e-shop. They're going to get rid of their dealer network at some point. That's going to be very bad. It's going to be like because Tesla started that trend where they're challenging the rules about whether or not you have to have a live dealer, because it used to be they forced you to do that. This is interesting. Sports betting is being voted on in all these markets. So recent bill passed for and recent bill introduced, all those places might get sports gambling. So I think we should take a serious look at some of these guys. Right? Online betting for sports is going to be, you can't go to Vegas. It's going to become a bigger thing. I'm not sure, frankly, who's big in it and who's a real good. It says Pure Play is DraftKings, blah, blah, blah. And they're pretty high in their range, and I doubt they're worth $16 billion. So we'll have to look at these guys carefully and figure out, who to go with on this kind of stuff. But it's an interesting place to play. Gain is Marin Software, 200%. That's cool. AstraTech. Snap had a great day. 33% for Snap. That's crazy. See, my daughter told me to buy Snap. She knows what she's talking about. Paid no attention to her, but she does know what she's talking about. That was big. There was something else that was important. I don't know. It's interesting, this Google thing too, but it's going to take years to play out. I don't think it's going to really have a big effect. Cruise line battered by cancellations until March. Cruise lines are screwed. That's a terrible, terrible business to be in now. They just keep pushing. It's like Boeing. They just keep pushing back the date when they can restart. IMF slashes Asia growth forecast. Asia's economy seen contracting 2.2%. Worse than expected before. This is, again, markets all-time highs. The entire Asia is having a contraction. Wow. Let's see if that can get bigger. There we go. So here's your 2020 growth projection, minus 4.3% for the entire year. Next year plus 3.1. So we're still down over 2 years, 1.2%. It's not going to be until 2022 when we're back to where we were in 2019. Yet market's up, 50%. Europe won't be back at all. I mean, Europe's down 8.3% this year. And again, stimulus. The difference here is it's the same. We got to hit the same. Notice how they're down 8.1, they're down 8.3. Why are we not down? Because massive stimulus. That offsets a decline. And it's assuming that we're going to keep going that way. Europe is coming back. Also, Europe had a lot of stimulus too, but it's been terrible. Everyone's stimulated, but it didn't help, right? This is 2020. Minus 8.3, minus 8.1, minus 4.3, 4.1, 1.7, 3.0. Everybody. Global contraction for the year. That is really hard to make up. And that's why and that's why my general opinion of the market is it's way overextended. This is not logical. How does that translate into all-time highs for companies? How could they all be priced so much higher than they were last year when as a group they're not making more money than last year? Just means you're paying more money per earnings dollar for these companies. So we're buying at very expensive prices. Don't like that. Bitcoin's getting all excited again. Anyway, so that's what's going on there. See if anybody has any questions in particular. Oh, thanks, Robin. Robin says I'm a good teacher. I appreciate that. So speaking of which, we were talking in the chat room. Let's talk about what we said today. So you have to consider the environment in which this is happening. We ran up on stimulus hopes. The stimulus hopes were taken away. Now we're back in the cycle of stimulus hopes. Maybe we'll get some stimulus, but if we do get it, is it enough? Is it going to have the effect that we want it to have? How are the consumers going to react? There's a lot of questions still to it. I don't think, in the bigger picture, where's my biggest picture? Let's say Yahoo should be the biggest picture. So if we look over at the S&P, and this is obviously this was the time to be an investor, right? Look at that, 1988 until 2000. It went from 250 to 1,500. So that's up like 500% in just over 10 years. So that's why when you see these gains that we have now, they're not completely out of the question. And here you are in the 80s, went from 100 to 300, so it was 200% for this decade, but then 500, so up 200%, then a correction, then up 500%, then another correction, right? This is one big correction basically, and then up from a bit, basically 6 to 3,500 is another 500%. But that's the problem. What happens after you run up 500%? That's from 1,500 down to 800 or so, yeah, about 800. So basically a 40% correction. Now, are you going to avoid that? It's kind of hard to say, isn't it? Very, very worrying signs. Either this is worrying. When you see these giant reds, huge volume upswings when it's red, and then back down when it's green, that's not a good pattern. That doesn't indicate any long-term strength. You know, but that's a big picture chart for the S&P. So 5 years coming into now, we've had a hell of a run. But honestly, I mean, you know, so you put the thing in Trump into context in 4 years, it's a good 4 years, but it's not all that impressive, frankly. It's just, you know, pretty much normal. There's been many times we've had this kind of gain in the S&P. The thing is, though, can you sustain it? Was it built on something real? And clearly, if we're making, these companies are making less than they made in 2019. So what's the midpoint of 2019? Maybe about here. Call that the middle of 2019. So 2650. And companies are now making less than they were making then. Yet we're paying 34, paying 800 more, basically 30% higher per dollar earned than it was back here in 2019. And also what bothers me, so that bothers me obviously. Also, we know 2850, we've never changed it, because why have we never changed 2850 as a must-hold line for the S&P? We never changed 2850 as a must-hold line for the S&P because that is the true value. It's the same true value we had in 2019. That value is based on what companies are making times a reasonable multiple for those earnings. You know, to some extent, you could argue that there are no viable alternatives for your capital, which is somewhat true. The dollar is being devalued. You don't want to keep your money in cash. Bonds and bank accounts are not paying reasonable rate of return for your capital. You don't have an alternative there. Housing is a dangerous market, not necessarily rising anymore. So you have less choices to put your cash. So therefore, the market can command a premium because it's something that you have a lot of competition for people to put money into. The problem is, though, that all things change. And think of how, and this is where you get your 40% correction, because think of how drastic it's going to be when that situation changes. What if housing becomes hot again and people want to pull their money out of the market? What happens if bonds, which are paying all-time low rates, start paying normal rates again and become a hot investment item? What happens when corporate bonds, which are currently paying junk bonds and things, are paying a terrible rate of return right now? But what if they start to put up a better rate of return? So where's what about tax-free municipal debt? What happens when that starts paying? In other words, when all the money is going into the stock market, that means all the money is in the stock market. So there's junk steadily climbing, because more and more money is going into the junk bond market, because it's one of the only places you can get 3-4% returns. But if the market collapses, you can get burned really badly on this ETF. That's why we don't play it. But it's just a good indicator of where things are. So in other words, money's not going into houses. Money's not going into too much commodities, not really. I mean, obviously gold and silver is an alternative, but money's not being held in cash. Money's not in the bank. Money's not going into municipal bonds, things like that. Money is going into the market. And the market's getting pushed higher and higher, and you're paying more and more money to be in the market because it's a crowded space and everybody wants some. But what happens when people want to move their money to something else? The problem is if everyone is in the market, then who's going to buy it when you all want to get out? Where's the buyer going to be? If all of a sudden people want to rush out of the market and into something safer like municipal bonds, or if the Treasury decides they're going to put out some kind of bonds like a 100-year bond at 2%, and everybody goes, holy crap, 100 years at 2%, we'll take that deal. If they try to liquidate their stocks and people are no longer running into the stock market, what's going to happen? Same thing that happened in 2008. Everybody wanted to get out, nobody wanted to get in, and the market collapsed really hard and really fast. So that looked like this. What the hell's that? Oh, it's weird. Why does it do that? I don't know if we can use this thing. Oh, we can't. Look at that. It's broken. Huh. Gotta use the max thing. Okay, so first we find 2008. Just trying to see what happens. It distorts badly. I don't know how to fix that. Maybe if I go that way, no, that doesn't work. Oh well. So here we were, la-di-da, having a good old time, going from 980 to 1500, which is not very dissimilar from where we are, what we're doing now. Because 980 to 1500 is like 50%, right? So here's a 50% gain in the market. And we just kept going up and up and up. And I was being Pollyanna here, and I was saying it's because at this point, sometime in 2007, I started telling everyone it's going to crash, it's going to crash, it's going to crash, it's going to crash, it's going to crash. And I sounded like a broken record all the way into 2008, or basically the end of 2007, when suddenly big crash. Then an even bigger crash that caught us all by surprise. We got this crash, and I was like, oh, great. That was a nice correction. Now let's buy some stuff. That didn't work out. We bought some stuff, and it all went crashing down again. Much worse. But look at the speed of this decline. Look at this decline. This is from Christmas, and that is January 21st. So in 1 month, we went from 1210. So here, 15 basically to, I won't let me do that. Trying to find the right spot. Okay, so 15 to 13 is like, it's not that bad. It's like, it's not even 20%. So we didn't have, it was like less than 20. It was a 20% correction, no more. Then we bounced a bit, but we failed at the bounce line. Then we had a really sharp correction here. I can't believe I can't just do this. Why can't I? That's better. Very ugly. Okay, there we go. All right. So, and this is horrific. Look at this. I mean, 922, 929. So these are weeks. Uh-oh, ran out of recording space. So this is it, guys. You're going to get one shot of this because it's live. I think we ran out of recording time. So 922, 929, and 6. So that's a 3-week period. We fell from 1251 to 899. So 400 points, basically, 450 points out of 1250 is like 30% in 3 weeks. I mean, we're not done. And we bopped around, and we fell further again. But that's the real killer, though. This is where people are selling and nobody's buying. And that's what it looks like. That's what this looks like. Selling, no one's buying. Selling, no one's buying. Selling, no one's buying. The market drops like a rock day after day, and you can't even believe it's happening. And that's exactly what we're setting up for right now. You've got too many people all in the same asset class. Everybody's in equities. And when they decide to leave equities, who is going to be putting the money in? Who's going to replace these people? And so the reason in 2007, all same things this summer, really. I mean, all summer long in 2007, I was saying, get out now, get out now, get out now. And everybody's like, ha, Phil, look, the market went higher, blah, blah, blah. And I just kept saying, get out now, get out now. And all of a sudden started dropping. And even I was a sucker, though, because when it dropped down to here, I thought it was a good time to buy. And we bought some stuff. Then it dropped again. Then it came in. Once it dropped again, though, I kind of got more like, just stay out of this freaking thing. It's a disaster. But that was my mind change around here, because when we got this thing and then we dropped again, I was like, oh, screw this. This is very bad. It was looking very, very bad. And we had to just wait for the bottom to come down. And it was a long, tedious wait, just like we're doing right now. Nobody's patient. Same thing that happened to me in 2008. We got a lot of subscribers left because they're like, oh, you're not buying enough stuff. I want to buy more stuff. I want to be more bullish. But it doesn't matter, because I mean, the reality is those people couldn't afford a subscription a year later. So I don't see the point in catering to those people. It doesn't make any sense. I'm telling you that this is the same conditions, the same kind of situation. If you remember back in 2007, Bush did a stimulus, and it was also very expensive because he was trying to boost the economy. Not because of the 2008 crash. He was boosting the economy just because it wasn't going fast enough for him. And the Republicans, to this day, same mentality. They think that the stimulus, they think the market is how you rate your president. That's all about whether the market is high or not. And they just point to that number and say, everything's great, re-elect this guy or stick with this party, don't change parties. Let's see. Where was that? George Bush stimulus check 2008. The Economic Stimulus Act of 2008 was February 13th. Okay, so what were we trying to stimulate on February 13th of 2008? Well, we had dropped, like I said, we had dropped 20%, and they thought that was enough where they wanted to stimulate the market. That was the result of the stimulus, right? So right now, what are we doing? We're stimulating the economy. Right now, the market dropped, they freak out, they try to stimulate the economy. How long did it last? Well, here's February, and here's March, and here's April, and then kaboom. And that's why I don't have all that much faith in the stimulus stuff, because history does repeat itself. That was when they sent everybody, like, I forget what the amount was. It wasn't a lot of money, though. It was a smaller stimulus. The total cost of this bill was $152 billion. That's nothing. We're blowing the doors off that. So it's, so you have to say, well, stimulus might help, it might not help. And you have to think about, how much are we really putting in? How much does that affect on the economy? But what I'm saying is, either way, whether it works or it doesn't, as far as boosting things right now, the long-term effects, you can't count on this. You don't know what's going to happen in 2022. Because we're already up on stimulus already. The stimulus started here in June. Frick. So this year's stimulus came in around here, April, May, June. We were discussing it, we talked about it, we implemented it, and by August we ran out of money. And then what do? We start talking about it again. And now we're talking about the stimulus again, but it's only the same stimulus here. So the question is, how much has the economy actually improved that the stimulus will do more than just fill in a hole? If you're trying to fill up your pool with water and it's got a gigantic hole in it, and the hole is bigger than the amount of water you're filling up, it isn't going to fill. These are math problems. We used to do these when we were kids, right? Like how much water is coming in, how much is going out, what's the rate of drainage or filling of the pool? And it's determined by volume, and we have not done enough to fix the hole. We have a great big hole in the economy, and money leaks out, and we are dumping money in. And the problem is, and that's really another part of the problem, is that the money is not really being allocated to filling in the hole or to fill the pool, a huge portion of that money is scooped up by people in the top 1%. And instead of going into the pool, the overall economy, it goes into the market. And it just makes the market more and more expensive. And that's why you have this incredibly growing wealth disparity between the rich and the poor, because the rich are taking all this stimulus money and not using it to stimulate anything and just making themselves richer, and the poor are getting, as usual, getting trickled on. And they are not getting the real benefits that these things are supposed to do. And obviously they know that. The Trump knows that. The other Congress people know that. They know where this money goes. It goes to rich people. It's an excuse to use the government's money, which is the money that we all pay in taxes, including the poor people, and you're using it to enrich the rich people. You know, just like the old days with Robin Hood and crap, right? They used to go around to the towns and villages, and they would, basically force them at knife point to pay over their quote taxes. And for what? Did the government come in and build roads or construct things or make waterways or do something? No, government didn't do crap. All you were doing was paying for protection. It was a gigantic protection racket. Knights would ride into town, they would collect taxes, and they would bring it to the king, and he became richer and richer and richer, and he would spread some around to the nobles and the lords to make sure he had enough knights, to protect himself and make sure he had a gigantic army. And that was capitalism. It was called feudalism then, but it was still capitalism. The protection racket. And that's all this is. It's the government is taking the money to protect you from the virus, and they're taking money from everybody, and they're giving basically nothing back. This moonshot for the vaccines, the government's not putting any money into this stuff. The government is putting money into things that have nothing to do with helping you. Boosting the market, buying stocks, having the Fed spend money on ETFs, keeping interest rates low. Most of those things have absolutely nothing to do with helping poor people at all, helping regular people. And it's not doing anything to stop the virus and protect you from the virus. They don't want to stop the virus. The virus is what gives them an excuse to take all the money and do whatever they want with it. It's really unfortunate. It's being used as a major scam. Oh, and there's Trump. Trump wants a stimulus deal in 48 hours. Why does he want a stimulus deal in 48 hours? This is his last chance to steal more money. He needs this money. He's not going to get another chance in life to have $2 trillion to play with and hand out favors to all of his friends and so on and so forth. And he needs a lot of favors because this dude's going to jail if he doesn't start doing it. He better have a lot of favors to cash in. But you know what's going to happen is Biden's going to pardon him. That's going to be the conditions of Trump leaving office peacefully is going to be he's going to negotiate a pardon. And it'll be a blanket pardon, like Nixon got, like a blanket, like no matter what he did. So when they uncover the fraud, the corruption, and so on and so forth, he'll be officially blanketly pardoned. And I'm sure the Democrats will not want to embarrass the office of the presidency by dragging this thing out. So good. So we got that to look forward to. Anyway, as long as he's a private citizen, I'm going to be a happy camper. Anyway, so where are we? So here we are, October 19th. We hopefully, the market likes to make these M patterns. It makes M's and it makes W's. So hopefully we're not making a big, giant M that goes way back down here. And that's how long? This is only 1, 2, 3 months. So we could have 3 months of declines. If we're lucky, we'll hold up around 3,000 or 2,800 over here. But we had good consolidation at 3,000. So with any luck, we won't go past 3,000. Oh, there's going to be a beige book today, I think, but it's not until 2 o'clock. I don't want to spend time on this today, but let's see where we are. We had Last week, 38 up. Wait, do we remember our numbers? 38.3 million plus 7.87 million. That's a little disturbing. That seems to have gone up a lot. Oh, well, and then we've got deaths. We have 1.09 plus 2163. All right, so those are our numbers. Now we're going to refresh. You know, it's just important to know if you're accelerating or decelerating, or how, you know, what kind of rate we're at for things. Very slow. Where'd the map go? Yeah, all right, oh, here it comes, very slow. All right, oh, I want to see clear. So cases went from 383 to 409, that's 2.6 million people were infected in the last 7 days globally. 2.6 million people in 7 days. Remember, this was considered a crisis when China had 80,000 infections. And whatever the number was, 2.6 million people, 2.7 million people really, in 7 days have been infected now. That's more than three times China's total infections. So the next number, 787, has now become 2.82. So that looks like 500,000 more people to me, right? So 500,000 Americans have been infected. So of 2.7 million people in the world, 500,000, 25% of those people infected, Americans. And somebody wrote to me and said, Phil, I don't know why you're so worried about the virus. Most people get it, have mild cases, so on and so forth, and most people who got it are fine now. That's not true. Most people who got the virus, and I said this last week, are here. This is the last 30 days. Those people, this block that goes from, you know, basically here to here, this block of people, which is, where's this number? Oh, these are dailies, it's not a total. Anyway, so this block of people here is only a month. Those are active infected people. And also, when you have these numbers recovered, how much is recovered? 2/3 recovered, not mostly recovered. 2/3 recovered. 1/3 of the people are active case. I'm sorry, those are dead. Anyway, so it's like 2/3 are recovered. The rest are still infected. The rest still have symptoms. It doesn't just clear away in 2 weeks. It's not a miracle thing. It can linger and last for a very long time. Then we've got 221,000, oh, sorry, 1.26 million deaths. It was 1.09. So that's in global deaths. We've got it's 109. So that's 2.3 million. No, sorry. Global deaths, only 1 million. So it's 1,026,000. It wasn't 1,009,000 or 1,090,000, 090. So that's 30,000 deaths, I think. Is that right? Yeah. So it's 36,000 whatever deaths total in the world. Now, in America, we went from 216 to 221. So we had 5,000. So 5,000 Americans died in a week. So we're a little bit under 1,000 a day, like 700 a day, 800 a day. 5,000 Americans died in a week. So that's where we are. So 5,000 people died this week. Whatever that huge number was are infected. 8.2, 500,000. Jesus. Keep having to check the numbers. It doesn't make sense. 7.9 to 2.3. I'm sorry, to 8.2. 300,000 people. That's crazy. I mean, these are crazy numbers, guys. This is horrible. Anyway, so again, didn't want to dwell on it, but the point is, still spreading incredibly fast, still affecting tons of people, and no end in sight. It's nothing about this is improving. And it's accelerating. I mean, I keep hearing this from people, it's accelerating. I had a very depressing conversation with some PPE people, and they were talking about the long-term needs because this thing is just not going away. And we're in no way, shape, or form are we doing enough to stop it. So we will see where that ends up. All right, oops, looked at that. Now it's retail sales we talked about last week. How's the portfolios doing? So the long-term portfolio, we didn't make too many changes, so still up about 110% because we haven't really dropped very much so far. And it's only from the weekend. And the short-term portfolio, 471%, so pretty good shape. Okay, so that's 110 was 550, and if this is 550, you're up around 1.6. So it's 155. It's yeah. So we're just up around 1.6 million. Okay, so it needs to be adjusted still from the changes we made, and we'll take a look at where we actually are. But we're, the portfolios are in good shape. The dividend portfolio is 7.7%, which, is frankly what it should be doing. It's supposed to be paying dividends and making a small profit. The earnings portfolio doing super duper. Future is now 65%, and the money talk portfolio 22%, not terrible considering we don't touch it. Newsletter portfolio 16.7%, and I don't know. Yeah, let's see. I'm gonna talk with those guys about whether we're going to continue with this because it's not. I don't see any return from these guys. And the butterfly portfolio you can't go by because I didn't take out the expired ticker, so we can't tell what the hell it is. But I'm sure it's doing fine because everything came out the way we thought it would on Friday. So we were talking about that, and we didn't get far, did we? Try to go over stuff, and I'm like, oh, get sidetracked. You're running out of disk space on this PC. Wow, what a disaster. Oh, this is disturbing also. Like, look, this is global economic activity. It was here, and now it's here. That's not good. So, globally, we still have, and when the whole planet is slow, it's not like the corporations are off somewhere else making money. It's because that's the same thing over and over again. I'm sorry, it's just a slower economy that we should be very cautious about investing in. And people are not being cautious at all. And when everybody suddenly decides to be cautious, it's going to be way too late to pull your money out. Way too late. You will be going, does anyone, I mean, you guys forgot what happened in 2008. The broker systems shut down. You couldn't even sell your stuff. Things closed. The market crashed. They shut trading down. But it didn't matter. When they opened it back up, you couldn't access Thinkorswim. It was down for a day. You would call your traders and your floor traders and whatever. They couldn't sell. You could tell them to sell something, but they can't sell at limit. They can't do a limit sell. They're gonna sell at the open at market prices, and they're gonna kill you. That's the problem. And we were lucky because we recovered pretty quickly. It only took a couple of years to recover from that, not with any great stimulus either, because it was a very narrow problem in the housing and banking sector. It was a mostly narrow problem because the housing market collapsed. It was way overpriced and stupid, but that was a benefit for consumers because they were able to spend their money on other things besides houses. And the government mostly bailed out a lot of the homeowners, so not that many people lost their jobs and so on and so forth. The banks got creamed, but it didn't matter the banks got creamed because they also got bailed out. It was narrowly focused. This is a much, much more widespread problem. This is like the Great Depression. This is like one thing leads to another thing and leads to another thing. Like in the Great Depression, the final straw, everybody was over leveraged. Same kind of crap though. I mean, that's what happens with most of these things. Everybody's over leveraged. Too many people are in the market. But in this case, you had too much money being lent out to farmers and developers and so on and so forth. And then when the market did crash, it started with the farmers in the Dust Bowl. And when things did fall apart, everything collapsed one by one by one. So the farms started collapsing, the banks that were lending to the farms collapsed, the homes around the farms collapsed, and we were a 90% farming economy at the time. And then that screwed up Wall Street and dried up the money, and everybody was stretching for cash and so on and so forth. And money was backed by gold back then, so you couldn't just make more. Everything was backed by gold and silver. So you couldn't make more of it. So that's what happened. That's why we had the Great Depression. There was nowhere for people to go. But you know what? We have a global virus right now. There's nowhere for people to go. And the only difference is now we print money whenever we feel like it. So we pretend it's okay, but it's not okay. You got to know when you're pretending. We are just pretending it's okay. It's not okay at all. This is a total catastrophe. And we're not, because we're pretending, we're able to act like the virus isn't that big of a deal, and this isn't something we have to deal with. But it is something that we have to deal with. If we don't get our arms around this thing, if we don't stop this thing from spreading, if we don't take whatever radical action needs to be taken to control this thing, it's going to be with us for years, and it's going to continue to damage and slow down the global economy. And that is not good for the market. Free money is good for the market, but it's at a certain point, the free money is going to run out. Talked about that this morning too. So this is still running backwards. Federal tax revenue is still going backwards. That means the economy is shrinking. Every minute it's shrinking. Less taxes are being collected. That's not a good thing. It's weird I have to actually say that out loud, but it's not good. But the debt, 27 trillion, and it's only October 21st. We got all of November, all of December left to go. 27 trillion without the 2 trillion in stimulus. 2 trillion more in stimulus, 29 trillion, 30 trillion by the end of the year. The total deficit is $3.1 trillion. The total collections are 3.4. So that means that, well, obviously, here's your total spending. So we're spending $6.6 trillion. And the deficit is $3.1 trillion. So if we cut half our federal spending, we would still have a zero deficit. We'd be doing nothing to pay back the debt. We would just be maintaining the debt by cutting half of all government services. This is catastrophic. I mean, yes, we had the virus spending, but even so, Trump's budget was a good trillion in debt before they started. So he was going to be $1 trillion in debt, 4 trillion. So if you have no virus and we cut government services by 25%, then we'll be about break even on revenue. Or we could raise taxes 25%, or we could do both. But even if we do both, still running a deficit, still got to pay things off. Somewhere around here must say interest on the debt. Unfunded debt interest, Total debt, no. Debt per taxpayer. I don't know. It's a bad number. it's a bad number. Here you go. 137% of our economy is debt. And we're going to add 2 trillion to that, which is 10% more. So it'll be 147%. Oh, here it is, interest on debt net. So, oh, there you go. So here's our budget items, right? So interest on debt, $341 billion. And that's with incredibly low, obviously, it's 1% interest, right? So 1.1 would be 270. And so it's 70 more. It's very, very little more. 1.3% is the average interest, 1.3, 1.4%. So that's where we're at now. If this goes up to 3%, if the interest goes to 3%, that number doubles, and the interest on debt would be $700 billion every year. So again, budget busting items. How much are we spending on defense? $700 billion. That does not include veterans aid and things like that, and its benefits for veterans, and there's many other categories that belong to defense that they're excluding from that part of the budget. Social Security, 1.1 trillion. So when you talk about cutting the budget, the government budget, if the total government spending is 4 trillion, here's 1.3, 2.4, 3 trillion right there is defense, Social Security, and Medicaid. That's $3 trillion out of 4 trillion in spending. So if you say, oh, the government can cut $1 trillion in spending, what are they going to cut? They can cut all of their discretionary budget. There will be 0 government services whatsoever. No education, no transportation, no health and human services. No, it's a Republican dream, right? I mean, absolutely no regulations of any kind. And then we would still maintain Social Security and Medicare until they run out, but they will run out. Now, and of course, that's another thing when they talk about cutting these things, right? Where does the government money come from? Income tax revenue. Look at this. 1.3 trillion is payroll tax revenue. So if they cut these programs, then the people won't pay that, and then this government revenue won't be what it is. It won't be $3 trillion. It'll be 1.6 trillion plus whatever little money corporations pay. Oh, there it is, 214. It's such a joke. 214 million in corporate taxes. So if you talk about cutting Social Security and Medicare, and then the people don't pay it anymore, then your government revenue becomes this, 1.6 plus 2 is 1.8, and you have a worse deficit. There's no good outcome here. So the thing we have to do, and we do have to do it, you don't really have a choice, but the thing we have to do to save the economy right now is to spend more money and put ourselves into an incredible debt hole. But that debt hole, you can't get out of it. How are you going to get out of it? What are you going to do? You can't grow your way out of it. Well, I mean, the only thing you can do is attempt to grow your way out of it, but you can't grow your way out of it. It's completely unrealistic. So we have major troubles. What you really have to do, the only viable solution for this is hyperinflation. So the way because you're not really growing your way out of it, but you're allowing that. That's why the Fed is easing off on all their inflation control courses going out the window, because if you allow inflation to go like it was in the 80s, to be like late 70s, 80s, to be 10%, 12% a year, then your economy grows 10% a year, and then hopefully can grow, and then you still have to maintain controlled spending. But the idea is you grow your economy faster than you're growing the spending, and that shrinks the proportion of your debt to GDP. But the problem is we don't follow through on that, because we should have kept going. U.S. debt and growth per year. National debt crisis, the U.S. is broke. That's not helpful. public debt, national debt statistic, national debt growth by year. Oh, here you go. National debt compared to major events, blah, 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 blah. Here we go. That's helpful. So, the worst we ever were before was World War II. So by 1946, what is this one? Debt in billions, debt to GDP. Okay. Oh, it doesn't say what your economy is, though. Damn it. Does it show you economic growth? No, it doesn't. That's not very helpful. All right. Well, I'm not sure we can figure it out from this. So the debt went from pre-World War II, 43, we were 42% of our economy in debt. We went to 269, we're 118% in debt. But of course, 269 compared to 43 is 6 times. But we didn't go up 6 times in debt, right? We only went up 3 times in debt. Or 4 times 42, 16, wait. Yeah, 4 times 42. So we went up 4 times in debt. So what does that mean? That means the growth outpaced, the wartime economy growth outpaced the debt growth by 50%. Still a horrific level, but at least we did something. All right, Truman's first term. So World War II ends, Truman has his first term, budget, and a recession. Recession, recession, recession. That's what happens after you do this. You can't help it. And we got the debt down a little bit. Debt didn't change much, but the economy kept growing. See, you didn't add on more debt, but you grew the economy. That's the key. Did not add more debt, grew the economy. Did not add, a little bit more debt, but grew the economy, grew the economy all the way through the 60s. This is when America was actually great. We were growing the economy, not taking on much more debt. All right. Then Nixon came along, took us off the gold standard, initiated wage price controls to contain inflation that was coming along at the time. Then we had stagflation, stagnant economy, and still had inflation. Then we had that OPEC brouhaha. Then he got impeached. But meanwhile, we had never owed less money. We were in good shape then. Still stagnant economy with inflation. Then Ford came in. Remember, you have those whip inflation now buttons, right? So we had a stagnant economy and inflation, but we were keeping the debt under control. Carter comes in, still keeping it under control. Reagan comes in, things start changing drastically, right? Reagan does a tax cut. They're spending a lot of money that we don't actually have. And we suddenly go from, Volcker raised the rate of the Fed to 20% to try to start getting the inflation under control. But this is the least money we ever owed when the rates were 20%. He raised interest rates to 20%. But we went, during Reagan's time, we went from 998 to lowering taxes, bullshit like that, increased spending, lowered taxes, increased defense spending, went from 908 to 2.3 trillion. And then Bush came in, we had the S&L crisis, we had to bail out the banks. That really shot us up to 3.2 trillion. Another recession. All right. This was a crisis when Clinton came in, right? Clinton comes in, 64, he drops it down to like 57 or 55. Then Bush comes in. Now, given obviously we were attacked on 9/11, and Clinton didn't stop the borrowing. Well, he did stop the borrowing. That's not true, actually. So that's true, because he came in here. So Clinton comes in at 4.6. He leaves at 5.6. So he still ran up $1 trillion in debt, but he got it more. But he got the economy bigger, so the trillion was less part of the economy. And then Bush, like I said, we got attacked on 9/11. We started all these wars, and we went from 5.8 to 8.5. Crazy. And then we have the S&L crisis. Oh no, sorry, we had the S&L crisis back there. Then we had this Bush was here. Then we have this all this bullshit, the Katrina, the bankruptcy, the Fed, blah, blah, blah. He goes from 5.8 to 2 to 10. Meanwhile, we had a total collapse of the economy, so Obama comes in and starts spending. And now here we are today. And then Captain Crazy Pants comes in. we're completely off the rails. And that number is going to be $30 trillion when Trump walks out of office. He's going from 20 trillion in 2017. He's going to add about 10 trillion total dollars to the thing. And yeah, obviously, crisis, problem, blah, blah, blah. There were better ways to solve it, though, than just throwing money at rich people. That's not going to solve this crisis. So, and the point is that, look, you know, where it really goes crazy, though, is here's where we get killed. Look at what happened here. 61, 62, 62. That was manageable. 68, 82, 91, 95. That's where you've got your problem, right? That's where you're growing your deficit. And this is Obama. This is where you're growing your deficit so fast it can't keep up with your GDP, and then your GDP doesn't actually recover. And your debt does. Your debt keeps going, going, going. And that's where we are right now. But so this number, 136, and now it's going to be 150, is worse than it was in World War II when it was 120, 118. At the worst, we're already past that and going much higher. And that led to years of recession after World War II. Recession. And if it wasn't for the war, we would have had a recession this whole time. Another recession. Eisenhower recession. You know, so the 50s were tough. Still a recession in 57. Eisenhower still a recession. Here's a recession. Very, very bad. All right. So, you know, we're coming off some pretty good times, and you got to be, you know, it's fine if you can ride it out, and there's ways to make great money during a recession. There's stocks we can bet on, utilities and things like that, and just keep having money in a recession is good. And not everything should be in the market. There's things to do, like start businesses and do stuff like that. But you got to have the money to do it. And honestly, like it's such a dangerous time to be in the market. Oh, forgot about the oil. Oh, look at oil. Good. Okay, making some money. So, you know, you can't just play for the sake of playing. You have to have a reason to be in these things. You have to have some insight into the company and what it's doing. You don't just put money into stocks for the sake of having money in the market, and don't chase stocks that are overvalued. Very easy to know if a stock is overvalued. Is it getting more than 20 times its earnings? That's already a big red flag. And if it is over 20 times the earnings, it should be growing fast enough that within 2 or 3 years, it'll be below 20 times earnings. And if it's not doing that, and not fantasy growth, not like Beyond Meat, Impossible Burger growth or whatever, where it's like, oh yeah, of course, if they do this much and this much and this much, or SpaceX, whatever, it's like, yeah, if he launches 5,000 satellites, blah, blah, blah. Like, no, real growth. What's actually happening? Like Tesla, who's going to have earnings tonight. What's actually happening in that company? Are they really going to grow at this kind of pace? Are they really realistically going to be able to do this? If Tesla was going to double their growth in the next 2 years, where are the plants? How long does it take to build an auto plant? How long does it take to build a battery plant? You've seen them make a plant. We've seen them do this. It takes years. So if he had this Fremont plant that was an old Toyota plant, the one that is his main plant in California. They retrofitted it and started making cars, and then everything after that was putting on more production lines inside a factory they already controlled. The next stage of building has to be a brand new plant with a brand new assembly line, new cars, and new and the gigafactories being finished, and they're going to need another gigafactory to supply all the batteries. Where is the groundbreaking on these things? Where's the work being done? What's starting this thing? Where's the cash to make it happen? You can't just say we're going to double the amount of cars we produce. You got to be able to actually have a plan to do it. People who have business plans, even corporations that are existing, have business plans where they show their work. Oh wait, here's the beige book. Banks worry delinquency rates may rise in the coming months. No shit. Wow, that's what they got out of the beige book? That's sad. The banks are worried delinquency. Meanwhile, JP Morgan, that's a very big trick the bankers play. The JP Morgan and others, they cut their reserve ratios because it makes them look more profitable. WSJ. Let's see. Well, Purdue Pharma pays $8.3 billion. Bad Purdue. Virus stimulus talks make progress despite resistance. Oxford developed COVID vaccine. Businesses were Google. Nothing about the beige book. All right. Well, I don't want to read it. That's going to be boring. I don't like the way they do it anymore. That's the problem. Their presentation sucks. All right, let's see what it says. Overall economic activity continues to increase across all districts. That's good. Pace of growth characterized as slight to modest in most districts. That's not good. Changes in activity vary greatly by sector. Manufacturing activity generally increased at a moderate pace. Yeah, wishy-washy. Residential housing continued to experience steady demand for new and existing homes, with activity considered constrained by low inventories. Banking contracts cited increased demand for mortgages as a key driver for overall loan demand. So people are moving out of multifamily homes. People are moving out of apartments and going to single family homes because they think it's safer. They're changing their lifestyles, basically. Also, you know, if you work all the time, you know, if you're in New York City and you work all the time, you can put up with your 1,000-foot apartment with 2 people in it and a baby, and you're hardly ever home and you don't deal with it that much and whatever. But when you are home all the time and you're in a little tiny apartment and you're raising children or something like that, forget it. You can go insane very quickly. So I'm sure a lot of people can afford to, moving out to the suburbs and getting their own places and so on and so forth. You see, the thing that keeps you in New York, right, paying like triple the rent that you would be paying or triple the price that you'd be paying for something in the suburbs, is that you are closer to your work and you like to take the subway to your office and blah, blah, blah. But now there's no office. Now there's nowhere to go. And everybody's working by commute. So it's going to kill the cities. You know, this virus keeps going, the city life is going to really fall apart, because the city life depends on people's willingness to overpay for apartments. But why am I overpaying for an apartment? Well, I like to be in the city. I like to go to restaurants. I like to go to shows. I like to be able to take the train to the office. None of these things are things you want to do anymore. Then why am I paying more? Why am I paying double, triple what I would pay if I were 15 miles away from the city? I mean, most of us, I'm a suburban person. I mean, I wouldn't stay in the city. It's too crazy, the money and all that. So most people have made that decision already in the suburbs, but there's still millions of people in the cities who have places and live and keep all these restaurants and everything afloat. These guys are going to be leaving, and that's going to wreck the tax base of the city. And then you've got to distribute the tax money across less people, and they're going to leave because of the taxes and so on and so on. It's not a good cycle. Conversely, commercial real estate conditions continue to, isn't that funny? That's exactly what I was saying. So conversely, it's not conversely, that's the problem. So whoever wrote this doesn't understand the concept. In other words, obviously, commercial real estate conditions continue to deteriorate in many districts, with the exception being warehouse and industrial space, where construction and leasing activity remains steady. Consumer spending growth remained positive, and remember we talked about that over here, that the pattern has changed drastically. Consumer spending growth is not bad, minus 1.8, but individually, minus 11, minus 16, plus 11, plus 12, minus 16, minus 34. There are sectors being destroyed, and they're not the same. They're not the sectors that are supportive of the city. Some districts report a leveling off of retail sales, a slight uptick in tourism. Obviously, from zero, it's a slight uptick. Demand for autos remains steady, but low inventories have constrained sales to various degrees. Reports on agriculture conditions were mixed as some districts are experiencing drought conditions. Oh God, on top of everything else. Districts characterize the outlooks of contacts as generally optimistic or positive, but with considerable degree of uncertainty. This is the problem too, okay? When you start talking about the characteristics, the outlook of contacts, because the beige book is an opinion survey. They just sit down with their friends in their districts. So the Fed governors sit down with their people they know, the business people they know, and they just take notes and they ask them questions, or their staff will ask them questions, and they'll get a sort of a survey of what people think is going on. So you have to take into account that some of these people, a large portion of these people may be Republicans, and they may think that the virus is going to be cured and it's not a big deal and it's all going to go away, blah, 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 blah. So it skews the polling. And they don't, and you know, it's not a professional poll. They really don't take that into account. It's a very anecdotal report. Restaurants in many districts expressed concern that cooler weather would slow sales, right? Because you're being forced inside and they can't do that, as they relied on outdoor dining. Banking contacts in many districts expressed concern that delinquency rates may rise in coming months, which is what the news decided was the most important thing in the report. Citing various reasons, however, delinquency rates have remained stable. Why they remain stable? Because we're giving everybody money. That's why. If we don't keep giving people money, they will have big problems. So we have to keep giving them money. But what are we giving the money for? That's what I was talking about. We're not giving people money to stop the virus. We're not giving people money to build new businesses. We're giving people money to fill in the hole so that we can give the money. So in other words, I'm giving you, Mr. Poor Person, money, Mr. Middle Class Businessman, I'm giving you money so that you can give it to the rich banker who you owe money to. What does that fix? Doesn't fix anything. Doesn't improve anything. Doesn't put jobs on the table. It doesn't make people buy capital goods. It's just to stay alive. You're paying I'm giving you money so you can pay your landlord to have an empty restaurant in his building, to make sure he doesn't take a loss. So to make sure my rich landlord Trump donor doesn't take a loss, and to make sure my rich banker Trump donor doesn't take a loss, I'm going to give the poor people money. That's the conditions under which poor people are being given money. Not to actually help anybody or help anything. If you want to make a good use of money, you hire 5 million people to clean everything every day. And you give money to the companies that make disinfectants and wipes and so on and so forth. And you make everything like a cruise ship where there's like 100 people's jobs is to wipe down surfaces and clean everything and spray everything, so that every day we've killed 90% of the coronavirus. The coronavirus has been left on surfaces from the day before. And by the way, that was another huge Trump lie that I'm done with this. Well, all right, well, we're not done with this. All right, let's read this. But coronavirus on surfaces. Okay, so coronavirus can survive on plastic and stainless steel for up to 3 days, cardboard for 1 day, blah, blah, blah. But it turns out it's way worse than you thought. And they said before it was 24 hours or 2 hours or things like that. That was a lie. And China knew it was a lie. All right, so it's a virus cleaning China. So Asia in general, they know it's a lie. This is what they do. That's a subway of some sort, okay? This is what they do. They clean and they clean and they clean and they clean and they clean. There's millions and millions of people employed cleaning everything all the time. This is how life is. People are always cleaning everything, every surface, to make sure the virus doesn't have a chance to spread. Not going to be 100% effective. Here, look, you walk through a tunnel of disinfectant. I don't know if I really want to be doing that, frankly. But this is normal life for people in Asia. This is what they do, because this is how you fight the virus. You have to do something. We're not doing anything. You check people's temperatures before they go in a store, before they go anywhere. You make sure nobody has a temperature. If they do, you send them home. Or in China, they send you off to a internment camp. But it doesn't, I mean, it doesn't matter. At least some degree of this should be being done here. We're doing no degree. This is what you spend money on. Not making sure the empty store is paying its rent. And obviously, I'm not saying my heart, I don't think that you should let the empty stores fail, but the priorities are really screwed up, because you can't reopen the store because you're not fighting the virus. Oh, and by the way, our airlines, I was having that conversation yesterday too. Our airlines are doing this. They do that because they're a private corporation. They can't afford to let people get sick on their planes. So our airlines, which are private companies, are doing this kind of work to clean everything and keep it disinfected. And our airlines have been actually very safe. There has not been any particular spike in incidences among people who fly in airplanes. You have to keep your mask on. Why? Because even though there's 100 people in a little metal tube, right? They all have their mask on, and these guys go through and disinfect everything between every flight to make sure there's no virus left on the plane in between flights. So it's just you and your mask and whatever you touch for 4 hours. And they also mostly keeping empty middle seats also. But it can be done. In other words, so if you have the willpower to do something, you can fight this virus. You can stop it from spreading. But you've got to have the willpower, and that comes from the top. And here's the subway being cleaned. I don't know if that happens in New York or anything, because the subway was a major source of our outbreaks. But this is what you have to do, and we're not doing it. And if we're not doing it, and we already have whatever the hell number is, 8 million people infected, that's like back here. Well, that's not the U.S. Let's see if this thing changes. Hello. That thing's not. Oh, there it goes. Okay. So, this is 60,000 people a day. We're starting at 60,000 people a day here, and we're not doing anything about it. Here is where we were doing stuff about it in the summer. We were telling people to start wearing masks, and more people wore masks into the summer. Now we're going the other way, and we're saying, oh, don't worry about it. This was the last time we thought we were recovering over here, and then we eased our restrictions and went like this. If we are doing that here, if this is here, and we're now heading into this, but instead of starting from 30 going to 70, we're starting at 50, and we're going to go to 120,000 people a day being infected, which is 1 million plus people a week. Won't be long till we're all infected, right? And he coughs right on command. Where's my tea? All right. So, look, these are just reasons to be cautious. And it's so obvious. And that's the problem though. This beige book doesn't take that kind of stuff into account. It's just somebody's opinion. And a lot of these people's opinions, because you're talking to wealthy business owners in the report, a lot of these wealthy business owners, they don't believe what's actually happening. But what are we really doing to stop this from happening? We're just bailing everything out, but we're not fixing the hole. All right, where are we? Employment increased in almost all districts, though growth remains slow. Employment gains reported most consistently from manufacturing firms. Firms continued new furloughs and new layoffs. It's kind of mixed. I don't know what just went in my throat. Most districts continue reporting from tight labor markets, attributing to workers' health and child care concerns. And that's another thing, child care concerns, the health concerns, things like that. What are we doing about it? We're ending Obamacare. We're not doing anything about child care. Why? A few districts and some firms were finding it easier to hire workers. Workers increased slightly, but most districts, wages increased slightly. Often tied to firms' difficulty in finding workers, especially to low wage or high demand jobs. Some firms reported returning wages to normal levels, but many reported more stable wages. Prices rose modestly along districts since the previous report. Input costs generally increased faster than consumer prices. That's not good for corporate profits. Input costs increased faster than consumer prices. Construction, manufacturing, retail, wholesale passed along higher prices to the consumer. That's good for them, but not good for the consumers. So the consumers are being squeezed on big ticket items. And then other things like probably food and things like that and services are not able to pass along the costs. So that's dislocation and problems also. And we should think about that when we're looking at the earnings reports to decide if we're going to make any bets. Overall consumer prices across districts rose modestly with a notable exceptions. Here's what you want to look at. So prices rose, but food, autos, and appliances they increased significantly. Sorry, food, autos, and appliances increased significantly. We know about the food problem from today. Gasoline prices declined. That doesn't matter because nobody's driving. Input cost increase at varying degrees, led by increases in material costs, particularly steel and lumber. Multiple districts reported continued additional costs for firms due to COVID-19, including personal protective equipment, sanitation equipment. Remember I said that's where like the retail is boosting in these areas. Testing equipment, technology needed for remote work. Changes in row crop prices were mixed, while districts reported declines in prices for animal proteins. That's interesting. So we aren't eating as many animals. That's a weird concept. See how that looks on the futures. Meats. Yeah. Long-term charts are not very encouraging, right? It's generally down, but China's having a food shortage, so hogs should do good because we'll be exporting those. Just this morning we talked about making a bet on DBA, the agriculture, the ETF, because that's how you hedge against food inflation. You go with DBA. See if we have questions. Brendan says SCO made a nice move. Oh, wow, look at that. Almost hit by 40-20 and I missed it. All right, we'll come out of that with something though. We'll see what happens. ONVTC mentioned this was a cheap stock. What is your price point and how does you view the investors from RAM business? That one I'm certainly going to answer in chat. That's a deep dive sort of thing we'll have to talk about. AT&T is taking a dive today. I think they were a little bit disappointing on their earnings or something. Hang on, let's see. All right, so remember to ask me about that in chat again, okay? Because I'm not going to get into the whole thing now. Oh wait, yes, really, Intel too. Missed that. Oh no, yes, twice. I get it. Okay, AT&T taking the dive. So that's not a dive. I think that's old news. I'm not sure when you asked that question, but apparently it reversed itself. Anyway, I mean, look, I wouldn't bet against him, obviously. We have AT&T. How is this? Let me make sure I got the right thing here. Yeah. So did they have their earnings? No, it's tomorrow. So they don't have their earnings yet. I don't know what people are freaking out about. So what was your actual question? He is close to its March lows. Yeah, yes. Well, that's why we liked it. The market is worried about the iPhone 12 subsidies. They're worried about the iPhone 12 subsidies. That's such idiocy. You're in a contract, and AT&T makes all that money back. That's completely ridiculous. They're worried about them spending money to make money. So that's fine. That's why we have such an easy time beating the market. People are idiots. How low do you think T can go? Well, we just started buying it, so I don't think it's going to go any lower than this. What calls would you sell to cover? I would not sell any calls to cover. It's too cheap. I don't get this line of questions. Like you paid no attention whatsoever to what we've been doing. Intel, you mentioned this is a cheap stock. What is your price point? Well, my price, I don't have price points. What are these questions? Jesus, guys. My price point is it's too cheap. That's my price point. I don't have a price point. Look, AT&T PE ratio 16. Their PE ratio is 16. They pay a 7% dividend. My price point is buy it at this price. I'm pointing to it. Here, look, see? I am pointing to this price. Pay that price. Get this dividend. Enjoy your life. Go out and relax. It's freaking AT&T. I mean, come on. Intel. Oh, Intel's PE is 9. 10. Let's say it's 10. Intel pays a 2.5% dividend, so not as exciting to own as a stock, but in either case, I think that's pretty cheap. All right, and then you look at Intel. So let's remember this is during a crisis. INTC. Speaking of Walgreens, how's Walgreens doing today? Oops, that's too many letters. Well, still making a little bit of recovery. So what are we doing? We're looking at Intel. All right, so here's Intel. A nice little company. So they made, 10 years ago, 40 billion, 50 billion, 50 billion, 53, 52, 55, 55, 59, 62, 70, 71. If I had to guess, I'd say they're going to make 75, 80, something like that over here in revenues. Their income, they had really good margins here. Apparently the margins contracted a bit here. They went 11, 11, 11, 10, 9, 21, 21. High margin era. That's going to depend on what cycle they are on the chips and the R&D and everything else. But the bottom line is they make a lot of money. They certainly make a good amount. Now I think probably somebody's betting they're going to cycle down and we'll get back to a lower margin going forward. But again, they're at 10 right now. Their PE is 10. If they go half, their PE is going to be 20. But they're still growing at a wonderful rate. So I don't mind that. As I said, if I can get 20 and I know there's some growth, I don't mind paying 20, but I won't pay more than 20 unless there's an exceptionally good reason to do so. This is 10. 10 times earnings you're paying for this stock. So I don't understand. It's like I don't get the question really. And what is my target? I don't have a target. My target is it doesn't go lower. So also, how do you view the divestiture of the RAM business? How do I view the divestiture of the business division that makes no money to get cash for things that do make money? I think that's a positive. Stop wasting your time with the RAM business. It's a low margin crap business. It's not what Intel specializes in. You're never going to make money selling RAM unless you have some incredibly amazing idea that's going to be faster and better than everyone else, which by the way, IBM already has. IBM is making three-dimensional memory chips. They're like cubes, memory cubes, and they store much more information in a much smaller space, and they're going to be taking over the world at some point. So that's why I like IBM long term, because they do radical stuff. You know, these guys are not doing radical things. So anyway, so these are blue chip businesses that are out of favor, that there's no lasting damage. And even if you look at them quarterly, so here's how they performed during a crisis. So revenues, last year, 16, 16, 19, 20. This year, 19, 19. In a crisis, they are making 20% more than they made last year in revenues. 20% more revenues than last year in a global crisis. Profit-wise, last year, 4 billion, 4 billion. Now 5.6 billion, 5 billion. 20% more money. 20% more revenue, 20% more profit. Why would you not buy this company? I really have to sit here and convince you to buy Intel? I'm sorry that there are idiots who are selling this stock. It doesn't affect the value of the stock. Intel, I don't know about. Intel, on the other hand. Okay, they crashed because people weren't happy with this report, but I don't care. That's why we started buying it here. It was a great deal. It's still a great deal. It'll be a great deal until it gets back to 60. Then it'll be reasonably priced again. But if you're not going to buy it on sale, when are you going to buy something? You know, these are the things I do care about. When when Intel's on sale, when AT&T is on sale, just because nobody wants it doesn't mean I don't. It's out of favor for whatever reason, and people are piling on, and they're putting, it's the same bullshit spin machine that everything else runs on these days, where they put the bears put in, it's not bears anyway, it's like what Kramer used to tell you, is how the hedge fund managers make the stock cheaper. They release a ton of negative outlooks. They put out negative outlooks, they get themselves quoted saying something bad about AT&T. It's like, oh, I don't know, this they're subsidizing these iPhones. It's going to doom them. Oh, yeah, like the last 10 times they subsidized iPhones, right? This is the iPhone 12. They have subsidized every single iPhone. Why is this time going to be damaging to them? Okay, how does AT&T do subsidizing iPhones? What's the terrible tragedy of their earnings as they subsidize iPhones? Let's see. 10 years ago, 122, 124, 126, 127, 128, 32, 42, 63, 60, 70, 80. I see a 200 coming along. How about money? Do they make any money doing this? 12, 19, don't know what that was about. 4, not good. 7, 5, 18, they're all over the place. 6, 7, 13, 13, 29, 19, 14. So I wouldn't count on 29, but I sure think I can count on 14. Seems to be right about the right path for these guys. Then that's, what do we say, 13 times earnings or something like that, or 16 times earnings? Again, it's inconsistent earnings. They're all over the place, but it's fine. And I don't need, and again, here's your problem, because you're always talking about target price. What's your target price? What do we do? I don't give a crap what my target price is for AT&T. Here's their quarterlies: 5, 5, 5, 4, 3, 4, 4, 2, 7, 5, 1, 5. Okay, but this is obviously a problem here that's unique. This isn't a trend. That's just where they are right now. And I don't need a target price, because if I'm going to buy AT&T, where are we? Oh. So if I'm going to buy AT&T, I don't need to play them to go up, not much anyway. I'm going to sell the $25 puts for $4 in 2023, and I'm going to buy maybe the 23, which is $5, and I'm going to sell the 30s for $2. So that's net 3 on the 23 30 spread. I'm paying net 3. but I'm going to sell the 23s for 3, so I pay net 0 on a $7 spread. So now it's a question of how much AT&T stock am I willing to own? So I'll say I'm willing to own 1,000 shares. 1,000 shares would cost me $26,000. I don't have a problem with that. In fact, I'll take 50,000 shares of AT&T. I'll take 2,000 shares of AT&T for $50,000. So I'm going to sell the $23 puts, and I'm going to collect $60,000. I'll sell 20 of those. Yep, I'll sell 20 of those for $60,000, and I will buy the 23, 30 spreads, 20 of those for the same $60,000. So I have a net 0 cost. 2,000 times 26,000, 2,000. That's interesting. I'm sorry, it's 6,000. All right, $6,000, not 60. $6,000 selling those. I knew something was wrong. 6,000 selling those, 6,000 buying these. And what am I buying? I'm buying a $14,000 spread. So I'm spending no cash. I'm buying a $14,000 spread that is 50% in the money, more than 50% in the money. And as long as AT&T is over 30 in 2023, I'm going to make $14,000. Okay. So is that the best way to go with AT&T? Well, I'm going to take a look at the dividend again. So what's my target? My target is over 30. That's my target. I don't need a target. It's going to be higher than it is now. So the dividend's $2. So in other words, if we bought the shares, we bought 2,000 shares, we get 4,000 a year in dividends. But that would mean I'd have to lay out the $50,000 now to get the dividend. I could sell some puts and calls, but the reality is I'm better off doing that spread. I'm going to make more money. I'm going to make $14,000. So that's the easiest path to success, right? I'm laying out nothing. I'm taking a $14,000 spread, and if AT&T is over 30, I make $14,000. If AT&T is anything over 23, I make some money. And my worst case scenario is I get assigned AT&T at $23, which is 20% below the current price. Well, not 20 cents, 15, whatever. Anyway, so it's low, so lower than it is now. My worst case scenario is getting assigned AT&T at 23. So I'm either going to buy it for 23, and I already consider $26.85 a good price, so I got no problem buying it for 23. And then I can sell puts and calls against it. And or if not, and if it goes higher, I can make $14,000 the easy way. That's it. So what's my target? I don't care what my target is. My target is this is a cheap price. I want to own it here. I want to put my foot down and make a stand and take a position. My target is irrelevant. I don't need one. Not to mention they pay out too much money in dividends to go up much. It's always a $30 stock. AT&T's been a $30 stock for 20 years because they pay out most of the money they make in dividends. There's no real growth. And how can there be growth? They're American Telephone and Telegraph. They are basically a U.S. phone company. They're only going to grow with inflation for the most part. They already have as many customers as they're likely to have. And China Mobile's another good one, CHL. And they're the AT&T of China. Oh, that's not it. Damn. I mean, that's the AT&T of China. They're paying a 6% dividend. They're at 33.35. Oh, which is which is 8 times revenue. All right, and China Mobile has how many customers? 950 million mobile customers and 187 million wireline customers. So keep that in mind. They have almost 1 billion customers. Okay, China Mobile has almost 1 billion customers. They have $135 billion market cap. So currently they're making, I hope it's in dollars. It's not. Shit. Too hard to do the math. Anyway, so, well, let's do it this way. If they're making 135 billion and they're at 7.6 times earnings, then we take 135 divided by 7.7. So they're making $17 billion, okay? You want to know how they make $18 billion? They figure out a way to get $1 more from each one of their customers, and they'll make $18 billion. They want to make $2 more, they charge $2 to each of their billion customers. This is insanely low. Now, I'm sure they're heavily regulated in China. They can't just do what they want to do. But the bottom line is they're going to be allowed by the state, as long as they stay in the state's good graces. The state will allow them, like any good utility, to raise their prices and keep accordingly. Therefore, when you have a chance to buy something at a rock bottom price like this, you take advantage of it. Do I have a target on them? Yeah, I have a target that they're probably not going to go below 6. Their T is not going to go down to 6. And that I think they'll be stable, and I think they'll be a good company to stick with, and they pay a healthy dividend. So I don't mind owning them. And if I don't mind owning them, then it doesn't cost me anything to sell a put. My risk in selling a put is owning a stock. So if I sell a put in a stock I really want to own, I'm not really taking a risk. So it's the same concept. Here it says you can get 480, but maybe a little bit less. They won't have a buck today. But it says you can get 480, so let's say 450, 460. So I sell that for 4,500 bucks, and then I pick up the 30-35 spread, which is what? Which is 540 and 320, let's say. So 320 to 540 is 240. So basically, I can do a 2-to-1 here. So I could do a $10,000 spread here. 20 of the $5 spreads is a $10,000 spread. And we could sell, what do we say we would sell? And then we sell $4,500 worth of that. So I'm sorry, what was the price? So again, it's the same kind of concept. It's roughly at 0. And my bet is that China Mobile won't fall 10%. And if China Mobile doesn't fall 10%, we make $10,000. If China Mobile does fall 10%, then we're going to own it for 30 bucks, which is 10% below where it is now. So if China Mobile goes 10% lower, I'm buying it. And if it doesn't go 10% lower, I'm going to get paid $10,000 for not buying it. It's very simple investing. And that's it, no problem. So, it's like, it's not something you should be worried about. Think of things you really want to own. And stop thinking about what's your target, where is it going to go, what happens next. Doesn't matter what happens next. You know what I bet on? I bet the world isn't going to end. And I know I'm doom and gloomy sometimes that it might end, but it's not ending right now. And if it ends, who cares? So that's the thing. So assuming the world doesn't end, and assuming people still use phones in the future, then China Mobile, AT&T are still going to be major stocks. Assuming people still use computers, Intel is still going to be selling chips for computers. Very simple. These are not complicated concepts. And we just make our bets accordingly, that these companies will be there, they will survive, and we don't have to bet them to go higher. We just have to bet them to keep existing, and we can make plenty of money doing that. All right. So thanks everybody for coming. I really have to go, and we will talk about it more next week. We'll talk about more of these fun things. All right. Have a good day.